So are alternative investments the best retirement plan? Now, I'm a former registered investment advisor known as an RIA, right? Registered investment advisor, but I call myself still an RIA, which is a recovering investment advisor, right? So I'm not an active investment advisor anymore. I'm recovering from that. But there's things that I've learned about it, right? I feel like I had a moment when I was doing that where it was like Neo in the Matrix taking the red pill, right? And just all of a sudden you realize like, oh my gosh, everything I've been experiencing about life is just not true. It may not be that dramatic, but it felt like that to me because what I thought was really helping people was actually really not helping people. And so when it comes to Wall Street, there's all kinds of things like counterparty risk, investment risk, lots of volatility, lots of hidden fees. And I think there's three main reasons you should consider investing in alternative assets for your retirement. So we're going to jump into it. Let's do it. I think you'll really enjoy this. All right, so welcome. My name is Bronson Hill. I'm the CEO of Bronson Equity. We do alternative assets such as multifamily. We do ATM machines, car washes. We've got about $200 million in multifamily and other assets, and we've raised about $35 million to help people like you get into different alternative assets that can make sense. So just a little disclaimer, I'm not an investment advisor anymore, so get your own professional advice. I want to give you, as we get into this, I want you to get into the history of stocks. Because when we think about traditional investments, I don't know what comes to mind for you. I think of stocks and bonds as being traditional. Now, this has not always been the case, right? Things that were traditional were real assets, right? They were alternative assets that they actually were called real assets, or we call them real estate, right? So it's actually something physical, something real. But if you look at what happened in 1929, everybody knows the crash. It was crazy. People lost 89% if you were just invested in the stock market. The index lost 89% over a few years, and it didn't recover for 25 years. So from 1929 to 1955, you can see this chart, it took that amount of time, 25 years to actually recover. And there was a saying around the time that people just would look at each other and be like, people heard they were investing in stocks and they'd be like, no, why would you invest in stocks, right? It was seen like the most risky thing ever, like it's the most non-traditional thing ever. And that was kind of how stocks really, looked at it. You can see all these crashes, the history of crashes the last 100 years, 20 to 90% loss. I mean, just incredibly risky. But this thing happened, and it's interesting how we got to where we are today, where these now have become traditional safe investments, right? There was this act called ERISA, which was the Employee Retirement Income Security Act of 1974. This is where basically companies switched from having to do a defined pension plan, right, or a defined benefit plan, like, hey, you get this amount, it's going to adjust to inflation, you just get paid a certain amount, to where it was just, no, employers are now actually just going to give you a certain amount, put it in an account, and you've got to figure out what to do with it. So you've basically become your own investment advisor that you've got to figure out what to do. Now, what this has created is a lot of money going into Wall Street assets, but it's really created a lot of people that have no retirement at all. So instead of having a defined plan of what they're going to get, this chart is just shocking to me, but it says 49.5% have $0 saved for retirement. Just think about that. 1 in 2 households, no one has anything saved for retirement. And then of those that are at the highest, over 5 million saved for retirement, it's 0.1%. 1 out of 1,000 households have that much saved. And then it was about 3.1% that's in the range of 1 to 5 million. So nobody has enough money, right? I mean, maybe you're somebody who does, there's a few people that do, but you gotta understand how rare this is, that people actually have money saved for retirement. And so now we're managing all of this. And this is kind of the history now. It's become that stocks and bonds have been considered traditional because Wall Street has done a great job marketing, right? They spend billions of dollars a year telling you these are safe traditional investments, even though they're not. And so I think it's just incredibly risky. What I learned about being an investment advisor is it was about getting people into suitable investments for their risk tolerance and where they are. But there are lots of risks of being in stocks and bonds. I'm going to share why I think real assets are better, right? And there's a lot of reasons for this, right? That I think we're going to get into it. But there are ways you can actually invest with a retirement account into these real assets. A lot of people wonder, I've had over 1,500 one-on-one phone calls with high net worth investors like yourself. And, basically, how do I get into these different types of accounts, or these different types of investments with my retirement account? Well, typically, if you have a Fidelity or Schwab or one of these company plans, you cannot invest in physical real estate. Typically, you have to invest in financial real estate, such as ETFs or other sorts of stocks or things like that. And there is a big difference. I'm going to get into why that is in a minute. But there's several plans. One's called a self-directed IRA. There's a group that does self-directed IRAs. We've the Solar One 401ks. They're called Rocket Dollar. They're pretty low cost, so you can kind of get in and basically you can invest in real assets through them. There's some that allow for real asset investment and some that don't. Like I said, the Fidelities and the more traditional ones do not. There's also something called a QRP, which allows for investment into these assets as well. So something to think about, but you can basically buy apartments, you can buy oil and gas, you can buy gold and silver, right? Buy gold and silver, you can buy crypto, you can buy all kinds of things inside of a retirement account. You're self-directed. The best ones I've found have something called checkbook control, where you don't have to get approval to invest in certain things. You're the administrator. You can basically, wire stuff. You can write checks. You can basically put things in yourself, and you have full control over it, which I think is really powerful. So I think with retirement accounts, being in cash flowing investments is awesome. Things that offer a higher upside. And then also, what I talked about before with the challenge of Wall Street stuff is there's something called counterparty risk. Now, what this means is if I own something with a retirement account or if I own something with a stock account, if anything in that group fails, then you don't really have an asset, right? You've got a piece of paper or you've got a digital thing that says you own something, maybe you don't own anything. One example of this you see is people that own physical precious metals, right? So I've got some physical precious metals here, or as an example, right? If somebody owns a bar of gold, they actually own the gold. Now, if you can buy this with your retirement account, you can own it, that kind of thing. What happens if you buy an ETF that owns physical gold? Well, they'll buy one bar or one coin and they'll sell not one share, but 20 shares of these. And how does that work? Well, they find a way, Wall Street will find a way to sell you stuff even if they don't have it and it's legal, right? So then if there's a run on it, who actually gets the asset? No one, right? No one gets it. Maybe somebody gets it, but it probably wouldn't be you, right? So it's something to just think about. With real assets as well, you have less counterparty risk. You also have tax benefits. With real estate, you get tax benefits. Obviously, if it's in a sheltered account, that's not as big of a deal. But again, having something that's real, that's physical, that's tangible, that doesn't have, one of the benefits is it's illiquid, which is, I thought that's a disadvantage, right? You can't buy and sell when you want. Well, one of the biggest things is our own psychology. If there's a crash, or you can always determine the value every moment of the day, every day of the year, you'll be more tempted to sell versus if it's only at certain intervals, every few years, every 5 years, whatever that investment matures, you're not tempted to buy and sell as much. So I think there's actually an internal control there as well. So when it comes to this, I think there's some things to watch out for in using retirement accounts to invest in real assets such as real estate. There's something that's really sneaky, and it's called UBIT tax. UBIT. UBIT tax stands for Unrelated Business Income Tax. And it's super sneaky. It's basically saying whatever leverage you use inside of a retirement account. So let's say I invest in a syndication deal, like this deal behind me here, and I put $100K into the deal, and it was a 20% down type of deal. They raised 20% of the money and 80% was made using leverage. It doubles in 5 years. So my 100K is now 200K. Well, they'd say on those gains, the gains, 80% of those, because that was what was leveraged, so $80,000, that would be taxed at normal income tax rates. Somebody could be paying 20, 30% or higher on that, which is still inside of retirement accounts. So very sneaky. So those accounts that I mentioned, a self-directed IRA will be subject to that tax. If it's a solo 401k or a QRP, it is not subject to that unrelated business income tax. So I think those ones are superior. If you can qualify for a solo 401k or a QRP, they're a little more expensive, but if you get one, it will really help you to avoid that tax. So the other thing I will say, things to watch out for is just because it's a real asset doesn't mean you don't have to do diligence, right? So I think that, probably the same or even more so, you've got to really get to know what's happening. I'm writing a book. It's actually coming out this month or next month. It's called Fire Yourself, Replace Your Working Income with Passive Income in 3 years or less. So I'm really excited about it. You'll hear about it more coming up here. But there's this chart that comes from it, and it basically has this funnel that has the market, the operator, and the deal. So when you're doing diligence, make sure you understand the market you're invested in. For example, this property behind me is in Huntsville, Alabama. I know about the market there, what the pros and cons, the strengths, the landlord rights, the business rights, the population growth, all that stuff I can tell you about because I know the market, right? Second thing is the operator. So who is the operating group? Who are the partners in there? What's their track record? And then the last thing really is, what does the specific deal look like? Right? What are the things that are actually happening with that deal? And so you really want to make sure that you're doing those different levels of diligence to make sure you understand. So bottom line is use retirement accounts to invest in real assets. I would say just do it. Get an account set up, go for it. The best time to get that account set up is ahead of a deal. Sometimes we'll have people that are interested in getting into a deal right when a deal is being offered, and sometimes there's just not enough time to do it. So do it ahead of time, get set up for it. Some stocks and bonds may be okay, but just, I would say just really, I'm obviously much more, skeptical of how those will work out long term just because of, how things go. So having some diversity can be okay, but really, you get comfortable with using retirement to invest in things that cash flow can be awesome. Okay, so I want to share this with you. This comes from Andrew Carnegie. He said 90% of all millionaires have become so through owning real estate. And he wrote this about 100 years ago when, to be a millionaire was like being worth 100 million now, right? So you think about that. Owning real assets is the way to get to true wealth. And so real estate is a great way to do it. Check out this video I did called Supercharge Your Retirement Returns. I get a whiteboard. I go through some specific things on how specifically you can get better returns within your retirement account. And if you haven't joined our investment club, check it out. We're doing these multifamily deals, oil and gas, ATM machines, car washes, things that are cash flowing that are working out awesome. So thanks for taking the time. I look forward to seeing you on the next video.